Hey guys, in this video we're going over, is my money safe in a bank? Some things they might not tell you. We'll first touch on how much money we're talking about, what kind of bank you might have, what could happen if a bank fails, what do I personally do, and at the end we could touch on Bitcoin and gold, and we could see how some people might be moving into those types of assets outside of the banking system. Everyone is different, so just remember to do your own research. So let's first touch on how much money you actually have. So let's look at if a bank, for whatever reason, fails, are you entitled to something? And you are. Every bank has insurance. If they go under, then you are insured for certain limits. We could first touch on the FDIC insurance. So you're insured up to $250,000 per depositor, so per person, per insured bank, so per bank, and per ownership category. So if it's just you on an account, you're insured up to $250,000. If it's you and a spouse, let's say, you're insured up to $500,000. You could do that across multiple banks if you wish. And if you don't have a normal bank, but a credit union, then they have their own type of insurance for you as well. So instead of FDIC, there is NCUA. So they have a share insurance fund, insures individual accounts at federally insured credit unions up to $250,000. So similar to FDIC with normal banks. And they also have that toward IRAs and retirement accounts. Right, so if you have if you have $1 million, which most people don't, but if a bank fails, they would only give you $250,000 and then you lose that $750,000. But if you're a normal person like I am, and let's say you have, $1,000 in an account and they go under, they can insure that $1,000 for you. So if you have a normal income, you probably shouldn't worry too much. Now the process of actually getting that money will probably take a while. That's not like, oh, you lost this money here, let me just direct deposit it into your account. It might take weeks. And just another thing that they probably won't tell you is that these insurances, like the FDIC, of all the money that they would have to hold to insure all the people and all their money, they don't have that money. So yeah, they'll probably get it for you, but the Fed will probably give them the money, and that's just how it works. Basically like another bailout type of thing. But for an everyday situation and an everyday person, a normal bank should probably be fine. But it does depend on the type of risk that the bank holds. So we touched on normal banks and also credit unions, and let's just point out what the differences of those are. A normal bank is obviously a for-profit. If you're talking about like JP Morgan, Chase, Bank of America, Wells, they have stocks, they're publicly traded, they want profits. Credit unions, on the other hand, are non-for-profit, so they're a little bit more friendlier, they'll able to help you out, better rates, and in general, they would be a little bit less riskier. Nothing is no risk, but they're usually less riskier than a normal bank. For example, a normal bank, depending on the investments that they have, they could be in riskier loans or CLOs, like that's what kind of collapsed the market in 2008 during the recession, or even risky derivatives. And one of the main problems there is all of those banks are intertwined. So if one bank fails, then some other banks could fail, if not just struggle a lot. And that's kind of what happened during 2008, and we started to see it during 2023, which we will see a pretty surprising chart on that soon. When I say soon, I mean right now. So check out this chart from FDIC. This goes back to 2001, but you can see the blue bars are total assets, and the red, let's say, bars are bank failures. And you can see 2008, there was a lot of bank failures. 2009, 2010, 2011, and then gradually went back down. And you can see in 2008, the total assets was just under 400,000. So massive amounts of bank failures. Then if you look in 2023, there was only 5 bank failures. But look at the amount of assets that it was affected. It was over $500 billion. That amount of assets surpassed that in 2008. 2008 barely had 20 bank failures, and then it obviously skyrocketed in 2009 and 2010, but there was only 5. That's insane. So those are normal banks. If you want to touch on credit unions, they're usually a little less risky like we mentioned before. They have more simple investments like mortgages or auto loans, credit cards, commercial, which is actually a huge issue that's been going on for the past couple years. But they're not trying to make money for their stockholders and maximizing profits. They're there to help their customers, and they also don't have a income tax because they're a not-for-profit. Now, there are big banks and small banks, and the credit unions are usually smaller, but I want to show you the difference of large banks versus smaller banks because there's a huge change going on. So this first one, not my favorite chart because it's only going back to, 2018, not as recent, but you could see the change. The number of small banks are declining, and the number of large banks are increasing. It makes sense because if a bank fails, like we saw back during the last recession, well, the '08 recession, the big banks just bought up the small banks and just left all the big banks left. This next chart I like a little bit better because it's going to 2022, but you can see there was a huge change from 2006 to 2010, and the amount of large banks took up maybe 40% of all of the banks, and then it shot up past 60%. And recently, it's now around, like 65, 70%. So the number of small banks are declining. There are more big banks out there, or at least taking up the share of the banking system. The problem with that is if everyone is just flocking to these big banks and they have all the money, they have all the power, they could essentially do whatever they want. And a recent article that came out, I actually had another video on it, they might be thinking of charging people for their checking accounts. And if everyone is in their bank, like everyone's flocking to these large institutions, they're able to do that. So if you are in one of these banks and it does start failing, like similar to that 2023, one of the biggest banks that ended up failing was Silicon Valley Bank. Millions were lost. Yes, some people's money was insured, but your account was essentially frozen. And if you had more than that $250,000, then those people lost their money. And they just didn't have enough liquidity. What was happening is people started seeing that the bank was risky, so they started pulling their money out. And when they saw that, more people were pulling their money out. And then more and more and more, and that's called a run on the bank. No bank can survive that. If everyone starts pulling their money out, they're done. And that's kind of what's happening with regional banks. This is just a quick chart of what happened to regional banks. This is just an ETF that was mirroring what was happening in the regional banking industry. And you could see in 2023, it completely dropped off. Now, it has been rebounding because people think that there's not much risk in the system anymore. Whether that's true or not, that's up to you. For me personally, I'm not touching this stuff. So with all of this stuff, what do I personally do? And I have been recently rethinking what I have of possibly moving into a credit union because currently I do have it with a large bank. And they're all kind of the same, to be completely honest. So it's really up to you whether it's more convenient to you, whatever works. Not that I agree with large banks being able to outlive because they'll be able to be bailed out. Even if they do fail, they'll be bailed out. I don't agree with it, but that's the truth. My last job, I actually worked at one of the banks that went under. Quick story, that was when me and my wife was in the delivery room. We were having our first son, and I was just watching their stock plummet. And I'm like, am I going to have a job when I go back? So this is certainly possible to happen. But they were bailed out just like everyone else. But going back to my personal accounts, I keep very minimal money in my accounts. Only enough for my bills, for my mortgage, for my credit card bills, and that's it. I transfer any extra money into my brokerage account, and then I buy T-bills for any type of savings. And T-bills are backed by the government. Now, not to say that I trust the government at all. However, they are safer than the bank. The government will most likely not default on anything. They will pay you your interest. If they don't, we have a lot more bigger problems to worry about. So I like saving money in T-bills because, one, they give me more interest than a bank account. I'm getting over 5% interest. That's backed by the government, so there's not much risk there. And there's also some tax benefits that for T-bills you don't have to pay any state income tax. Now I have been thinking of moving to a credit union just because they could have less risk. But the problem there, which a lot of people don't do, is because it takes a lot of effort. Like, your entire life is already set up to this bank account. Your direct deposit goes into your bank account. All your payment information gets pulled out of all your accounts already. Everything is just set up, and the banks know that. If you're already set up with a bank account, they know most likely you're not going to be jumping around. Now you can, it's not like it's impossible, but it's just more difficult. So either way, I don't keep a lot of money in there, so I'm not too worried about it. Now, if you remember in the beginning, we mentioned gold and Bitcoin, of how some people might be, they're like seeing all these bank failures and they're like, I'm not too sure about banking, this whole system anymore. What else are they doing? So let's look at this first gold chart. You could see it's completely skyrocketing. So it peaked, you could see the last recession of '08 and then skyrocketed, then came back down a little bit in 2016, and then went up during COVID, kind of consolidated, and then recently started going back up. Now that can be attributed to the expected rate cuts that we're going to be seeing probably soon, because if interest rates go down, gold is more attractive, because if you have like two choices of, I could put my money in an account that's gaining interest, or hold gold that's not paying me anything. So if interest rates go down, gold gets a little bit more attractive, because if you're getting less interest in an account, then it might make more sense to hold gold. And the other reason could be if they're not trusting to hold their money in a bank account, heck, maybe they just want to hold the gold. It's just outside of the system. Similar to Bitcoin. Look at Bitcoin. It's obviously all over the place, completely skyrocketed in 2021, 2022, and then fell off a cliff in 2023. There was a bunch of failures with a lot of crypto businesses and companies, but since then completely rebounded and is close to all-time highs yet again. And that could be seen as people wanting to get out of the system, whether it's the banking system. They don't like that type of risk, so they're taking the money out of the system and putting it into Bitcoin. Now, should you do these things? Now, that's really up to you. I actually might have another video kind of just talking about outside of the system investments like those things. Now, I do own both of those, gold and Bitcoin. I'm certainly not the person that I have like 100% of my investments in Bitcoin. That would be pretty crazy. But I mean, to be completely honest, that hasn't been a bad option because it's at all-time highs. But I think everyone should kind of have all of these different things. So at the end of the day, the question is your money safe? It is, until it's not. If stuff starts happening, if banks start failing again, if the economy starts collapsing, people become scared. And a lot of people want to have their situation already handled before that happens. A lot of people might say, I'd rather be a few years too early than a second too late. Hopefully this information could help you think a little bit differently, and you might even adjust where your money is or how it's set up. So if you're putting your money and trust into an institution, that's just added risk. How much risk? You'd have to determine that. Now, it's not like you can't have a bank account. Heck, even think of cash. Like, if something happens and you have cash on hand, there's not any risk with cash because you could use that anywhere to a certain extent. Some businesses don't even take cash anymore. But if, like, a bank collapses, you still have your cash. That's why, like, people used to put money under their mattresses or dig a hole in their backyard. The problem with that is inflation. As the currency devalues due to inflation, it's a hidden tax, the value of your money is declining. So you kind of need to balance everything, which is why I think diversification is a big thing. So essentially doing all of these options to at least help you out. So what do you guys think? Let me know in the comments below, and I wish you luck out there, and I'll see you guys in the next one.